The United States has a massive debt problem. It's been piling up over the years, and it's getting harder to ignore. The issue is that the government spends more than it takes in through taxes and other revenue streams. This deficit is financed by borrowing money, which adds to the national debt. The government revenue primarily comes from taxes and other sources. The continuous deficit forces the government to borrow funds. Gold is traditionally viewed as a safe haven asset. It is particularly favored during times of economic instability. Investors often seek gold when confidence in the economy declines. Loss of faith in government financial management also drives investment in gold. Gold is perceived as a store of value during uncertain times. A debt crash would have huge implications for the economy. Imagine a scenario where investors start to lose confidence in the U.S. government's ability to pay its debts. This could lead to a sharp increase in interest rates, making it even more expensive for the government to borrow money. As the debt burden grows, it could choke off economic growth, leading to a recession or even a depression. The value of gold could skyrocket in such a scenario, as investors seek safe assets to park their money. Gold is traditionally considered a safe haven asset due to its historical value and scarcity. Increased demand for gold arises as investors aim to protect their capital from potential losses. This surge in demand directly influences the market price of gold. As more investors buy gold, its price tends to increase significantly. Therefore, a debt crisis can trigger a notable rise in gold prices due to heightened investor interest. Excessive debt levels can contribute to inflation within an economy. Increased debt often leads to an increased money supply. This increased money supply can chase a limited amount of available goods and services. The resulting inflationary pressure erodes the purchasing power of currency. The 1970s in the U.S. were marked by a period of significant inflation. This high inflation environment had a notable impact on the price of gold. Gold prices experienced a dramatic surge during this decade. Starting from approximately $35 per ounce, gold prices increased rapidly. Within a few years, gold reached prices exceeding $800 per ounce. This represents a substantial increase in the value of gold. During the 1970s, the U.S. debt-to-GDP ratio compares the country's total debt to its gross domestic product. The current U.S. debt-to-GDP ratio is higher than in the 1970s. A high debt-to-GDP ratio can indicate potential economic risks. One risk is a decline in investor confidence due to high debt levels. Reduced investor confidence can negatively impact economic stability and growth. Understanding the relationship between debt, inflation, and gold is essential. This understanding is crucial for informed investment decisions. Debt levels can significantly influence inflation rates. Inflation erodes the purchasing power of debt. Gold is often considered a hedge against inflation and currency devaluation. Analyzing these factors helps navigate today's complex economy. Understanding the fundamentals of investment is crucial for sound decision-making. In conclusion, understanding the interplay between debt and gold is crucial in today's economy. The relationship between the two is complex, but it's essential to grasp the basics to make informed investment decisions. Continuous learning and adaptation are key to successful long-term investing.